Good afternoon, everybody. I'm Lucrezia Reichlin, I'm a professor of economics at London Business School, and I'm welcoming you today to our second webinar on the subject of disclosure, data, and infrastructure related to the climate risk here at the Wheeler Institute at London Business School. Today, the main speaker will be Ronald Cohen, Sir Ronald Cohen, probably well known to all of you. Hello, Ronnie. Ronnie is one of the father of impact investment. So the focus today will be broader than climate. And, we will just talk about impact investment and, the different aspect of it. Thanks, Ronnie, to be with us today. But before I introduce you properly, let me also say that this time we will have with us somebody else, another speaker, Maggie Whelan, who will help us, he will help me to moderate the Q&A session. Maggie is a London Business School MBA 2022 and one of our Wheeler Institute interns. She has a background in corporate finance with experience in audit, controllership, and financial analysis roles. And prior to the MBA, Maggie was based in Shanghai, China, leading revenue accounting teams in the region for a large multinational. A few words about the Wheeler. As you know, with the generous support of Tony and Maureen Wheeler, founders of The Lonely Planet, LBS has established a research institute that seeks to apply business expertise to social and economic challenges in emerging markets and low-income countries. Besides supporting and driving research and informing learning at LBS, the Wheeler Institute for Business and Development also delivers public talks and events like the one we are hosting today. Before I start, a few words on housekeeping. The webinar will last 1 hour. We will start with a conversation between me and Ronnie, and then I will start 20 minutes before the hour and give the floor to Maggie, who will moderate the Q&As. Now, the Q&A function is already enabled, so feel free to start asking your questions already in the chat function. So we will do our best to aggregate the questions so that everybody will have room for expressing, for asking questions. Okay, so that's all. So Ronnie, again, it's a pleasure to have you here. Thank you very much. Let me just say that Wikipedia describes you as the father of British venture capital and the father of social investment. So what I would like, so today we are going to talk, as I said, about impact investment, and in particular your last book, Impact, which you have seen like in the cover of today's seminars. But before we get there, it will be interesting to hear about your personal journey. How did you go from A to B, from venture capitalism to social investment? Now, you had a very rich career, and you started at McKinsey. Then in 72 already, you founded Apax Partners, one of Britain's first venture capital firms, which then became Britain's largest venture capital firm. And then you did many other things. As far as I can see, your change in direction was in 2000, or maybe it was earlier, I don't know. But it seems that was a turning point where the UK Treasury asked you to become the chairman of the Social Investment Task Force. And then after that, you did a lot of things. In 2002, you co-founded and then became chairman of Bridge Ventures, which is a sustainable growth investors. And so it would be nice to hear from you about your journey and tell us about how you got there.
Thank you, Lucrezia. It's a great pleasure to be here with you today and with Maggie to talk about these important issues. So I went to Oxford in the 60s, Lucrezia. It was an idealistic time, and I decided that I really wanted to do good and do well in the terms of those days. And when I went to Harvard Business School, I discovered venture capital, which was just emerging. The average size of a venture capital fund when I was at Harvard was $2.5 million, right? A risible amount. But I loved the idea that technology and young entrepreneurs could disrupt the leadership of big firms and create a lot of wealth in the process. As you know, I came to Britain as a refugee at the age of 11 from Egypt. I was aware that I would have to look after my parents, and so I needed to have a career where I could generate a sufficient amount of remuneration. And so I went into venture capital in order to create jobs in the UK. There were 3 million unemployed around that time in the UK. And I thought that I could both create jobs and make a lot of money by becoming a venture capitalist. But my aim was never to make as much money as possible. I was, by the age of 53, I said to my partners, this will be in 98, I said to my partners, I will leave when I reach the age of 60 in 2005 to deal with two important issues to which I'd like to contribute. Social inequality, because I came as a refugee, I was helped, I want to help in my turn. I'm also very disturbed by these differences in wealth that we've contributed to create through venture capital. I thought it would be a leveling process. And of course, we did help a lot of people who came from very simple backgrounds to make a lot of money and enrich their communities and their families and so on. But I could see that these differences in wealth were becoming extremely dangerous for our society. So I said to my partners, I will leave at 60 and we will institute a rule for everyone at Apex to leave at 60. So everyone can have a second career and contribute to solving a major issue. And at the same time, allow younger talent to rise to the top. And then, as you correctly say, by luck, and luck plays an important role in all of our lives, I got a phone call from the Treasury asking me to look at the issue that I was concerned about, that I was leaving Apex to deal with, which was the issue of poverty and all its social consequences. And when the Social Investment Task Force, which comprised about half a dozen very able people, looked at why we haven't made more progress with dealing with poverty, we realized that part of the reason, an important part of the reason, was that we had not been able to attract investment to social entrepreneurs who want to improve the lives of others in the way that we had done through venture capital for entrepreneurs who want to make money, quite simply. And it set me off on a journey to connect social entrepreneurs and the investment market, which went through, as you say, the creation of Bridges Ventures, the creation of social finance in 2007, which invented the social impact bond in 2010, the creation of big society capital 2 years later, using 400 million pounds of unclaimed assets in banks. These are bank accounts, as you know, Lucrezia, which have been separated from their owners for 15 years or more, and big society capital raised another 200 million from our major banks, and today has been responsible for about 3 billion pounds going to non-profits primarily, but some profit with purpose businesses, tackling important social issues. And then I was asked to chair the G8 task force, and of course you've just served on the G7 social impact or impact task force. The G8 task force in 2013-14 looked at the world and came back saying the world is shifting from risk return to risk return impact. In those days, the amount of ESG investment was about $13 trillion. Today, it's $40 trillion. We could see that young people didn't want to work for companies that were creating harm and didn't want to buy their products. The world of impact investment, which we defined to be both the intention of ESG, but also the measurement of impact, was non-existent. Today, it's more than a $2 trillion sector, with $1 trillion of sustainability-linked bonds and loans last year alone from a standing start. And so, if you like, I began to apply the lessons I had learned in the investment world to tackling social issues.
Now, let me just start from your book. So the book is very recent, and it's a little bit, a manifesto of this, what you call a change in paradigm, a sort of revolution that is happening in business and markets. Okay, so let's start from the concept, and then I'd like to get some examples as well. But it seems that this is a very challenging agenda. But the concept, as you call it, okay, so that we want to go from just returns and risk to return, risk, and impact. But can you just tell us a little bit more about that, and what are the challenges to follow that principles, especially in terms of how do we measure impact, impact on what, for whom, who establishes what is good and what is bad? Can you talk a little bit more about that?
So, Lucrezia, all of us on this webinar are very much aware that the world cannot continue to function in the way that it is doing. Our climate challenges are too big for governments even to be able to cope with them. And our social challenges, as shown in the Gilets jaunes and Black Lives Matter and eruptions in Chile and other places, are threatening the cohesion of our society. Simply put, capitalism served a fantastic role in lifting billions out of poverty, but investing for profit without worrying about the consequences on people and planet is no longer tenable. And so we begin to find it necessary to guide the invisible hand of markets with an invisible heart, which I call impact. What that means in practice is that through the measurement of impact to which you've referred, through regulation, through taxation, we shift to a world where it becomes extremely difficult to just make money. Just make money without worrying about the consequences has already become unacceptable today. This huge change in values that we've referred to has become noticed by investors. That's why you have 40 trillion of ESG and 2 trillion of impact investment within it, growing at 20% a year or whatever. That's a third of professionally managed assets. So investors are now, together with consumers and talent, changing the behavior of companies. But as you correctly point out, if you don't measure impact, how can you manage it? How can businesses manage it, or how can investors manage it? And so I've devoted a lot of time over the last 3 years, as indeed you have at IFRS, in looking at how do we standardize the measurement of impact so that we can measure the performance of a company, both in terms of profit and impact. And an effort which I'm privileged to chair at Harvard Business School, led by Professor George Serafim, a professor of accounting, whom you know, has shown that we can, through big data and computing power, artificial intelligence, we can actually measure and translate into monetary terms the impacts of companies. And if I may, I'll just give a couple of examples to bring this to life. So we've published a number of reports, more than 20 reports, about how you go about measuring different types of impact. There are three major categories of impact. The impact that actually 3+1, the impact that you create through your operations, the impact that you create as a company through your employment, and the impact that you create through your products. And the fourth one is, of course, the impact in your supply chain that you don't control directly, but that you have influence over because you can change it. If we start with the operating impact on the environment, we've shown 3,000 companies' environmental impacts, and some amazing insights derived from that analysis. 450 companies out of 3,000 create more damage environmentally in a year in monetary terms than they make in profit. 1,000 create damage of 25% or more of their profit. That implies that 2/3 create damage of less than 25% of their profit, and so can transition to net zero much more easily. Together, these companies create $4 trillion of damage in a year. And most interestingly, for all of us in the London Business School community, you can see a correlation already between higher levels of pollution and lower stock market valuations within several sectors. So the 40 trillion of ESG money has already tilted the scales in the direction of creating less pollution by reducing the valuation of those that pollute. And to give you
let me interrupt you here for a minute. So as we heard from Emmanuel Faber last week, and our work at FRS has been to try to, to be the background for the standard setting job that now the new standard setting board will have to do, to try to establish the effect on climate on enterprise values. Okay, so that's quite a relatively narrow concept. First of all, climate, there is a wide understanding on, how to measure that through scope 1, scope 2, scope 3 data, that's, and you can translate that in terms of what this, the different, what emission does for the value of the companies. Now, it seems to me that you have a broader concept, okay, so that what we want to measure is also what the company does to the environment. So you're not only talking to investors, to shareholders, but you have a broader, counterpart, if you want, which is, the community. And this becomes, of course, it's interesting, but becomes a little bit more complicated to define. And also from the governance and implementation point of view is a bit more challenging. Wouldn't you agree with that?
So I don't know that it's more challenging in this sense. The definition of what is required in terms of disclosure has to be made by investors at the end of the day. If investors today, as the Harvard data shows, are reducing the value of companies that pollute the environment, even though their profits continue to grow at the same rate, clearly these issues go beyond the profitability of the company in the near term or the medium term. So we already see this additional information that isn't relevant to the immediate profitability of a company affecting company value. And that's why I think our natural evolution is going to be to ask for all disclosures of interest to investors and let investors then decide which companies they want to invest in. Now, why is this going to happen? In my view, it's going to happen because when an investor measures the impacts of a company and tries to project the future growth and profitability. Very quickly, the investor comes to the conclusion that this revolves around additional investment that is going to need to be made and the attraction of talent and customers. Now, if you have a company that's polluting heavily and investors don't want to invest in it, and it reduces its value on the stock exchange and its price earnings ratio, you know, in financial terms, that's very significant. And I think we've only started with the narrower definition because it's easier to start with something that is narrower and that just looks at the profitability of companies. But when I speak to investors, they're interested in a lot more than that. So I think we're going to see, this is a debate around single and double materiality. I think we're going to see this distinction evaporate over the next 2 to 3 years. But if I can,
yeah. I mean, I agree with you actually that you know, this distinction is changing every day because the preferences of investors are changing. So that, I still think that you know, while on climate you could see you know, the power of what you're saying. I would imagine that on social issues and on broader impacts, things will, you know, be more complicated, and the evaluation of the trade-offs between impact and profitability would change depending on who you're talking to. And
so here again, Lucrezia, we've never really addressed methodically the issue of the economic cost of lack of diversity in a company. At the HBS IWAI, the Impact Weighted Accounts Initiative to which I've referred, we've just published 2,600 companies' employment impact in monetary terms. So in the case of environmental, you could say, we can see in the database that ExxonMobil creates $39 billion of damage in a year from its environmental footprint, from its operations, Shell 23 billion, and BP 13 billion. And we asked ourselves, well, how do we do the same thing in the employment area? And we came to the conclusion that you can view the exclusion of a group of people, a gender group, an ethnic group, whatever minority groups we think of. The economic cost to that community of that lost remuneration is what needs to be measured. And so we've taken 2,600 companies, about which we've been able to get detailed employment information. And we've analyzed it. And I can tell you as an insight that if you compare Amazon and you compare Apple in terms of their diversity debit, Amazon has a diversity debit of $6.7 billion a year. Apple has 2.5 billion from memory. But if you look at that diversity debit in relation to the total wage bill, Amazon is the better performer with 16-point-something% of its wage bill, and Apple the less good performer with 25%, even though it's better than some others in the tech world. So you can see how we begin to derive insights now about the level of diversity. Now, the total positive employment contribution is an order of magnitude bigger. It's maybe 2 to 3 times bigger than the diversity debit. So most companies, through the creation of employment, are delivering net positive impact. But by giving companies information, you begin to get them to focus on it. And just the other day, I published on LinkedIn a comparison between food companies' employment impact. And one of the companies, of the 3 companies whose numbers I displayed, called me up and said, you know, we're focusing on this issue. What information can you provide to us so that we know what we have to tackle? Is it we're underpaying people? Is it lack of diversity? Is it differences in advancement? All of which we're tracking. Now, are we going to get to a world where shareholders put pressure on companies to improve not just their environmental impact, but their diversity impact? I think we are. I think we already see in the resolutions tabled for shareholders' meetings for this year, resolutions that cover both the environment and social. So as this data begins to circulate, investors once again will make their choices. And obviously, if we show it in the data, if you have better employment practices, you have less labor turnover. It may correlate with better profitability and better stock market valuation in the long term also. So, I mean, these social measures or measurements, in my view, in the end, will be just as useful as the environmental ones.
So, you know, data is good, but it could also be a source of noise. Okay, from this complicated data set, you have to extract the signal, and then from you know, noisy information, and you need also to have you know, some agreement on what does it mean to compare, you know, apples with potatoes, and you know, in financial accounting, we have standard setters. Now we are going to have a standard setters also for climate. So are you envisaging like a mega global standard setter for all these different aspects of sustainability? And don't you think that this would be complicated, to say the least? And you know, since you know, I come from that journey on climate, and I can tell you that was not an easy journey. And you know, one of the reasons why it's complicated is because different countries, different jurisdictions have different objectives, because there is a different level of maturity on these issues, and you know, so this becomes immediately extremely politically charged. So that
yeah. Well, first of all, the question, are we going to be measuring impacts, has been answered through your efforts at IFRS and the ISSB establishment now. When the organization, which is responsible for all financial accounting across the world, except for the USA, but the SEC is involved in it, so the USA is aware of what is going on, says we're going to be standardizing disclosures and measurement of physical impacts, tons of carbon, liters of water, and so on and so forth. We've had the answer. We are going to be measuring impacts. That's what investors want. It's price sensitive, stock price sensitive data. Regulators are concerned that every investor should have that data on a consistent, comparable basis at the same time. So regulators are pushing in that direction. The next step is to value these impacts so that we can include these metrics in financial analysis and the valuation of companies in the way I've been saying. And I see that as a step to an impact accounting system over many decades, probably. But I believe that by 2025, regulators will mandate the publication of an impact statement by companies showing their revenues, their costs, and their different impacts. And the reason I am confident that this is going to happen is if you look at the historical parallel, in the 1930s, in 1929, there was the great crash, as you know, and investors woke up to the fact that they'd been investing without transparency on the profit of companies, because each company picked its own accounting principles, and there were no auditors to verify the numbers. And at that time, when the idea of generally accepted accounting principles, which was introduced only 4 years later, and the use of auditors, People screamed it would be impossible to do, and if it were possible, it would spell the end of American capitalism. Now, 2 years after the COVID-19 crash, in inverted commas, we have the ISSB being set up. There's an increasing amount of data circulating. It's stock price sensitive. Sophisticated investors get their hands on it because they know to go to the Harvard site and to other sites, and others don't. Regulators are going to have to step in and to do that. And so the effort at Harvard is designed to converge with the ISSB effort so that 3 years from now, the standardized physical measures that the ISSB is establishing can come together with standardized valuation coefficients and enable regulators to provide investors with the information they need to make decisions about the impacts of companies as well as their profits on a similarly reliable basis.
Yeah, let's shift a little bit the conversation. So we talked a lot about measurement, but what about? I mean, in your book, you also describe financial instruments like social impact bonds, outcome funds, development impact bonds, and so on. So can you tell us a little bit about that and give us some examples of success stories?
Yeah, I mean, this is really an exciting area, because when we invented the social impact bond in 2010, for the first time, there was a financial security where the return depends on achieving a social or environmental objective, right? So the government paid for the outcomes achieved in reducing the reoffending rate at Peterborough Prison. We reduced it by 9.7%. The investors got their £5 million back. They funded delivery organizations which achieved that reduction, and they got a 3.1% annual return. There are now over 200 social impact bonds in 35 countries, tackling 15 different social issues. But it hasn't gone further because neither philanthropists nor governments have really got their heads around the idea of paying for outcomes. There's a revolution in government and philanthropy coming with this impact revolution in investment. And yet the mainstream financial market grabbed the idea, and last year alone, as I mentioned, you had $1 trillion, Lucrezia, of sustainability-linked bonds and loans where the rate of interest that the borrower pays, a borrowing corporation pays, Enel in Italy, Novartis in Switzerland, because they have achieved a social or an environmental objective. So we are beginning to see the financial markets now adopting these concepts of outcomes-based securities that optimize risk, return, and impact.
Yeah, that's and you know, you in this context you were talking about philanthropy. I think one of the many interesting things in your book is to describe how the world of philanthropy has changed. And so, I mean, rather than me summarizing it, why don't you describe your main point on?
So philanthropy has been a broken model for a long time. If you look at what philanthropy has achieved, it's achieved a lot of good, but a big consequence of the philanthropic approach we followed is that charitable service providers have two characteristics, Lucrezia, as you well know. They're small and they're out of money. And the primary reason for this is we don't measure the result of philanthropy. We don't measure the outcomes. We measure the inputs to the activities. And we are shifting now the mindset of philanthropy, and it takes a long time to shift, as I've been saying, in the direction of measuring outcomes. This will lead philanthropists to do two things. One, within their grant portfolios, to allocate money that goes to outcomes-based grants. So they can pay for an outcome in education. They can invest in an outcomes fund that pays for an improvement in education. The contract that the outcomes fund signs with a delivery organization enables that organization to raise capital from a fund set up, the first one, UBS and Bridges, together, $100 million for education in Africa. And the delivery organization, if it pays 5 or 6 or whatever % on the bond, can, like a business, raise another bond in the future, a bigger bond. So I see philanthropy shifting to outcomes measurement. I see it shifting to pay for success, say 10 or 20% of its grant program. And I also see it now, and the Ford Foundation famously led on this path, allocating money from its endowment so that all of its endowment is ESG, and part of its endowment supports the mission that the charity or the foundation is trying to achieve.
Yeah, so that there is no contradiction between what the endowment is invested on and then the mission of...
Yeah, because this contradiction has meant that with 95% of the money in the foundation, you're creating problems, and with 5%, you're trying to solve them. By investing, you're investing in fossil fuel companies, and then you're using the 5% you give away each year to support environmental bodies trying to reduce pollution. As you say, it's an absurd contradiction. And the terrible thing about philanthropy is that actually the trustees of foundations are only responsible to the beneficiaries. Think about it. The beneficiaries have no voice, and the trustees don't have shareholders that keep them in line.
Absolutely. I think at this point, I will give the floor to Maggie because there are many questions coming from the floor, so that Maggie, why don't you take charge? And
Great, thank you, Lucrezia. So I think kind of maybe sticking in this topic of philanthropy and outcomes-based grants and securities, something that would love for you to touch on is sort of how we, and that being us as individuals, companies, organizations, are sort of supporting and increasing, the understanding of this kind of outcomes-based securities, results-based financing solutions within governments and other players, specifically in developing countries, which is, an area that the Wheeler Institute really focuses in on.
So we need to redouble our efforts, Maggie. That's the reason I wrote the book, because something huge is taking place. As Lucrezia mentioned, it's a paradigm change in our economic system, which shifts them to bringing solutions instead of creating and aggravating problems. Now, there's just been a report by the G7 Impact Task Force, on which both Lucrezia and I serve, and it basically focuses on this need for transparency and mandatory impact accounting and evaluation of impacts on the way, but also on boosting impact capital flows to emerging countries. And we need to harness these powers like sustainability linked bonds to specific social issues, in my view, in order to make progress. Like, we have to move beyond a theoretical discussion to saying, which the GSG is pushing for. We want to create mechanisms now for money to flow to small and medium-sized enterprises that account for more than half of employment in countries like South Africa, most countries in Africa. Or we want to address the issue of people living in slums a number which is increasing very significantly as a result of climate change, by the way, and the migration from villages to cities, and devote our efforts to using these new tools. So you can use outcomes funds to reskill 150,000 miners who in the green transition will lose their jobs in South Africa. So let's go about setting up these outcomes funds. Let's get the G7 countries, instead of providing loans only, to provide some grant money to go into an outcomes fund for reskilling. There's more than enough money opposite that outcomes fund to fund the delivery organizations that are going to reskill these workers to do jobs in the areas of infrastructure, in the areas of telecommunications, in the areas of clean energy, in the areas of construction, in rehabilitating slums or elsewhere. And so I think the answer to your question is by focusing on specific social issues and specific funding mechanisms for them. And if the Wheeler Institute can focus on that, it will play a major role in taking these applications to improving lives.
That's great. And I think, you mentioned kind of some of the GSG's focus and with the national advisory boards, kind of recognizing the individuality of these different countries, and sort of, you can't necessarily have one uniform approach, right? You have to think of, and Lucrezia, you touched on this as well, of the place and the context that every country or even every industry in may vary across the board. And so kind of going back to that question on how difficult or is it even a possible goal that you have this standard of uniform reporting, how specifically can multinational companies navigate that question when they're trying to come up with a framework for disclosure, but they have, operations in South Africa, in India, in Mexico, in the United States, Europe, et cetera?
So you're absolutely right, Maggie. And the unique characteristic of the GSG is it's 34, soon to be 35, and within the next year or two, 55 different countries, where you have local boards comprising people like the three of us, investors and business people and government officials and philanthropists and so on, to apply this thinking by persuading policymakers, by innovating in the use of certain financial securities and so on. Each country requires adaptation. So the idea of releasing unclaimed assets from banks started in the UK, but our Japanese NAB led to the release of $5 or $8 billion from unclaimed assets for social purposes. Our Korean NAB has led to the establishment of a $600 million organization. Our Australian NAB has just finished the task force pushing the Australian government in that direction. So we need to take this global thinking and translate it into local action. And that's what our NABs are doing. Now, with regard to corporates, as Lucrezia will tell you, corporates today are being deluged with demands for impact measurement. They're coming from completely different bodies, completely different questions, often the same question, but requiring different measurements. And so corporates are in need of some clarity now. So while many aren't very comfortable with the idea of exposing their real impacts, the pressure on them to expose them is becoming so time-consuming that I think they will happily settle for a standardized measurement system. Now,
yeah, I mean, if I can add on something, we had a public consultation before we started the work of the FRS, and the answer from the corporate world and the investors world was very clear. I mean, we need global standards. There are too many standards, too many requirements. It's called the alphabet soup, right? And however, so now we are proposing a global standards, but we need also that kind of flexibility that Ronnie was referring to, because different countries not only do things in different ways, but they have different, maybe different objectives because of, different public policy process. So what we need to have is a global baseline, and then, add on, but we need a coherent framework. And for that, there is a governance infrastructure at the global level that is very important, like on regulations, like on financial regulation, for example. We have the Basel Committee, and this is the same type of challenge. Yeah,
totally agree.
Lovely. So I guess kind of shifting gears a little bit and taking a question here more along impact in investment. So someone from the audience is asking, the Economist claims that impact investments can sometimes shift sort of dirty companies that might not be having the right kind of risk return and impact focus. And it shifts investment away from equity markets towards, shadow backers that are willing to invest in these companies and only care about profit. So how do you think, and how would you recommend addressing a trend, and does it exist? Is this sort of a valid concern?
Well, I have to say the Economist is way behind the curve on this thinking. I mean, it's looking in the rearview mirror. Unlike the Financial Times and so on. The answer is that you need to have measurement in private and public companies at the same time. A private equity fund that buys coal mines should have its negative environmental impact measured, and its investors should know what that is, right? Now, there will always be some people who are completely immune to outside pressure and continue to invest in tobacco companies. Fine, right? But you're not going to see the quantities of money going to tobacco that you saw in times gone by. And over time, the tobacco companies shift to, vaping and, other perhaps equally noxious products. So the answer is you need transparency in both public and private companies. There can be nowhere that you can hide an impact performance in the same way that you can't hide a profit performance, whether you're private or public company.
Great.
Even as an economist, I would agree.
It's a great insight there. And I guess, kind of continuing in this idea of, investment and market valuations, touching on something you mentioned earlier, Sir Ronald, of we've already sort of seen, companies with a higher level of pollution and seeing that linked to some lower stock market valuations, and that a lot of this ESG investment has already had an impact. And Harvard data is showing that investors are taking this into account. But you also talked about, we still have a long way to go. There are maybe decades more on this journey. So what are some of the major hurdles that we still have to clear on this road to net zero?
So I think the mechanism for this, or the dynamic of this revolution now, is that consumers and talent started it, investors then joined, and investors are now driving the change in corporate behavior, and regulators are needing to satisfy the needs of investors, regulators that have been set up to make sure that investors get the information they need on a comparable basis at the same time, and so on. The more this data flows, and so the more LBS is using this data in its research and and furthering the research. You have some great brains at OBS working in these areas and furthering the methodology and helping companies to think in terms of how they transition now to net zero, whether they publish transition plans, how they calculate the trade-off between investment now and improving it and your stock price, you know, and so on. So for all of that is going to put increasing pressure on regulators to act, because the more that data is flowing, the greater the pressure to make sure it flows to everyone. That's why I think that just as in 4 years you got to gap legislation and regulation, we got in 2 years to the ISSB, which is a momentous step forward. We can get in 2 to 3 years, in my view, to mandatory publication of impact statements. So,
yeah, if I can add something, I mean, the lesson I learned in the construction of the SSB that we need all part of society involved. I mean, this is something that is happening, that has happened in a way bottom up, okay, involving consumer groups, investors, and different group of NGOs and so on, different group of societies, and proposing ideas that seem to be very revolutionary only a few years ago, and now they are becoming mainstreams. And then, but without government and without regulators, it's very difficult to give legs and keep orders on these things. So, I mean, we need a bottom-up process, and then we need the top-down process as well. And in any, I mean, if you look at different areas of progress in social policy, this has always been the case, so it's not something that comes from a benevolent dictator or something that entirely comes from society. We need both. So in a way, this is really collective responsibility. Wherever you are in this geography, there is something to be done.
And I think the focus on greenwashing now, the media are focusing on it in ways they haven't previously, is going to push us in this direction, because the only answer to greenwashing is transparency.
And I guess, kind of, it's great that you touch on that sort of buzzword of greenwashing. And I think both of you can probably offer a great perspective on this question here, is sort of how can we, be it, the general public or, intelligent investors, differentiate, through this kind of transparent reporting, what is meaningful firm action versus what may be greenwashing, and maybe, Lucrezia, what were some of the measurements that you guys thought about when, you're talking about sort of building the ISSB, and in order to ensure that the metrics that are being published, or the reporting requirements that are being asked of companies are meaningful?
Well, I can start with the climate things, but there has already been a lot of work there. I mean, that what we are in the SSB/FRS, as Emmanuel explained last week, we are building on work that has been done by different organizations over the years, and we are just trying to with the experience of the IFRS in financial accounts. So we are just becoming more granular and trying to, make these standards also, more ready to get through an auditing process and to provide assurance. For climate, we will there will be standards, industry-specific standards. And disclosures will be on scope 1, scope 2, and scope 3. But as it has been suggested by, for example, by the TCFD, the Task Force on Climate-Related Disclosures, we are also asking companies to use stress tests to understand how the business model and the strategy of the companies are vulnerable to climate-related risks. And this is quite new, right? Because the question is not only, you know, how much you are vulnerable to risk, but also, you know, how your business model can adapt also to get the opportunities of these transformations. And so these are key concepts.
A big challenge, as Lucrezia and I both know, but you may not have focused on it, Maggie, is to get a single set of impact, generally accepted impact principles across the world. So somehow to bring the SEC, which is about to make on the 21st of March a statement about transparency, expected to be focused on companies, and the EU's efforts, which are focused on investment organizations, somehow to bring these together. And I think Lucrezia and the ISSB are the right forum to bring to the SEC in to a single set of standards. Now, it's a highly politicized issue. Anything to do with the financial system inevitably is, but that's what we have to go for.
And I think, unfortunately, that is all we have time for today. Before I turn it back over to you, Lucrezia, for final remarks, just want to thank both of you on behalf of myself and the rest of the attendees of the webinar for such a wonderful and insightful discussion and Q&A.
Thank you, Maggie. So again, thank you, Ronnie. Thank you, Maggie. Thank you to the audience. Let me remind you that a recording of the webinar will be available soon via the webpage of the Wheeler Institute Climate Initiative and the YouTube channel. Let me also recall that there are upcoming events in this series. On Monday, we will have Clara Barbie, who has worked quite closely with Ronnie, actually, and she will talk about building global consensus on how to measure and manage impact. And then on the 4th of April, we will have Frédéric Samama, who is going to talk about the new challenge of being carbon neutral by 2050. And then finally, on Thursday, the 14th of April, we will have Richard Cantor from Moody, talking about incorporating climate risk and opportunities, the insights from Moody's, from a leading credit agency. So now, if you enjoyed the conversation today, as we have mentioned in our conversation, Ronald has, there is this publication, the latest book, Impact, Reshaping Capitalism to Drive Real Change. So we recommend you to read it. And then Ronald will also be at LBS on the 1st of April as the guest speakers as the Student-Led Social Impact Conference. So see you next Monday, see you soon, and thank you for attending this.
Thank you.